Greetings and welcome. My name is Kristen Kolish, advisor and partner with the Mahoney Group of Raymond James. Thank you for joining me today as we learn more about our tax returns. The hardest thing in the world to understand is the income tax. Any idea who this quote was from? You may be surprised. Albert Einstein himself. If one of the world's brightest minds found taxes unintuitive, it's no surprise that your return may feel like another language. Today, I will break it down and walk you through how your tax return actually works, what the key numbers mean, and why understanding them can help us make better financial decisions. Let's begin by talking about how we get from your total income to taxable income. Every tax return starts with total income. This includes both your earned income like wages and investing income like interest, dividends, and capital gains, as well as distributions from retirement accounts like IRAs. From there, we subtract what are called above-the-line deductions. Things like retirement contributions, health savings account contributions, and certain self-employed expenses. What's left is your adjusted gross income, or AGI. For many retirees, their total income and AGI may be the same because they may not have above-the-line deductions. Next, we reduce AGI by the higher of the standard deductions set by the government for everyone, or your itemized deductions, which are specific to the taxpayer. The result is your taxable income, the number your tax is actually calculated on. For many taxpayers, 2025 may be the first time in several years where their itemized deductions could possibly be higher than the standard deduction. This is because of the tax law changes that increase the cap on the deductibility of state and local taxes, also known as SALT. This is income dependent and just another example of how the tax code and planning can evolve year to year. There's one other type of income that is worth mentioning, and that is your modified adjusted gross income, or modified AGI. It matters because it determines which tax benefits you may qualify for, as well as whether you pay additional surtaxes or Medicare premiums, that's known as IRMAA. We will talk about that more in a minute. These factors often have a larger impact on your total taxes than even your tax bracket alone. Modified AGI equals AGI plus specific add-backs, which can vary depending on the tax rule or the benefit being taxed. Common add-backs can include tax-exempt interest, such as interest paid on municipal bonds, foreign earned income, and rental losses. So let's move on and talk now about how income is taxed. Not all income is taxed the same way. Ordinary income includes wages, taxable interest on cash and bonds, non-qualified dividends, and retirement distributions. And this tax is based on a progressive tax bracket system. A common misconception is that once you're in that higher tax bracket, that all of your income is taxed at that rate, and that's not true. Only your last dollar of ordinary income is taxed at your marginal tax rate. The rest is taxed at lower brackets. Other income, like qualified dividends and long-term capital gains, may be taxed at lower rates, and that's dependent on your income level. This distinction plays a large role in tax-efficient investing. For instance, your stock dividends are taxed at a lower rate than your bond income. This is why the type of income matters, not just the amount. Two people can earn the same dollars in income and pay very different taxes depending on how that income is classified. Let's take a minute to talk about some other key tax terms and adjustments. There are a few additional taxes that can appear on a return. These don't apply to everyone, but when they do, they can have a meaningful increase in your tax bill and are something to be aware of. Alternative minimum tax, also known as AMT, is a parallel tax system designed to ensure that higher income taxpayers pay this minimum level of federal tax by limiting certain deductions and preferences, even if they reduce regular income tax. Next, the net investment income tax adds an extra 3.8% on certain investment-related income above certain thresholds. And for business owners, self-employment tax covers both the employee and the employer portions of Social Security and Medicare. For higher income Medicare beneficiaries, you may also have to pay IRMAA, which stands for the Income-Related Monthly Adjustment Amount. IRMAA is not officially a tax, but an additional surcharge added to Medicare Part B premiums, which of course is your medical insurance, and Medicare Part D premiums, which is related to your prescription drug coverage. IRMAA is calculated using that modified adjusted gross income figure I mentioned, and they will have a look back of 2 years. Large income events can unexpectedly cause IRMAA to increase, such as any Roth IRA conversions, maybe large capital gains, the sale of a piece of real estate or a business, or a one-time bonus or severance. And in certain instances, you may be eligible for an adjustment. So let's wrap up with why this matters for planning. Many workers and even retirees, their largest expense is their tax bill. Understanding how your tax return works helps us plan proactively. Strategies like maximizing pre-tax savings, constructing your portfolio in a tax-aware fashion, and managing capital gains through thoughtful rebalancing can reduce taxes over time. Your tax return isn't just a filing requirement, it's in fact a roadmap. When we understand it, we can make better decisions about saving, investing, and timing income. While we are not accountants, we are here to help our clients think about how tax management can in fact impact their financial plan. Thank you for listening, and be well.